Welcome to the deep dive. You know how we do it. We cut through all that dense corporate reporting, the analyst notes, the market noise, and give you the key insights fast. Today, we're digging into the U.S. housing market, specifically looking at it through the performance of a major home builder, PulteGroup, and their Q3 2025 results.
Yeah, and our goal here is really to give you that quick shortcut to understand how a big player like Pulte navigates, well, a really punishing economic climate. Q3 was notoriously tough, demand was all over the place, and affordability, I mean, buyers are just stretched incredibly thin. So we need to see how Pulte's model, their diversified approach across different buyers and places, actually held up.
And looking at the top line, it seems like they did more than just tread water. I mean, over 7,500 homes closed that generated $4.2 billion in home sale revenue. But what really jumps out and what we need to unpack is how they kept up a 21% return on equity over the last year. That's serious profitability when things are supposedly so tough.
It really is phenomenal resilience. And that's the core question for us today, isn't it? How do you keep that kind of return going when buyers are telling you week after week they can barely make the numbers work?
Yeah.
We've got to look at the specifics, how they managed costs, how they strategically tried to nudge demand along.
Okay, so let's drill down from that big picture into the actual financials. Q3 net income was $586 million. That's 2.96 per share. But the revenue side, like you said, tells a slightly softer story. Home sale revenues actually dipped 2% compared to last year.
Right, but they dodged a bigger drop because their average sales price, the ASP, had actually went up 3% to $564,000. And Pult says this was mostly about geographic mix. Basically, they sold more homes in pricier areas, maybe the Northeast, some coastal markets, that offset weakness elsewhere.
But that mix couldn't totally save the margins, and that seems to be where the real story is, right? Gross margin fell to 26.2%. That's down 260 basis points from last year, a pretty significant drop.
Exactly. That's the clearest sign of the pressure. The financial story of Q3 is really all about incentives, that margin squeeze, almost entirely driven by needing to offer more to buyers to get deals across the line. Those incentives hit 8.9% of the gross sales price in Q3. That's a big jump from 7.0% last year, and even up a bit from Q2.
And looking inside that 8.9%, it's not just, cashback or rate buydowns. Only about a third of it was purely financial stuff like that, or help with closing costs. The majority, like two-thirds, was actually discounts or upgrades through their design centers.
Which tells you something interesting about their strategy, doesn't it? It signals they're trying hard to avoid just slashing the base price of the house. They'd rather, it seems, load up the home with features or help with the financing side than cut the sticker price itself.
But hang on, isn't that a bit of a gamble? Focusing on design options, those upgrades, that appeals more to the move-up buyer, maybe the active adult, right? What about the first-time buyer who's struggling most with affordability? Don't they just need the lowest possible rate to even qualify? Are they sacrificing some volume there?
That's a really sharp point.
Yeah.
It is a calculated trade-off, absolutely. By focusing incentives on features, they kind of protect the appraised values of similar homes nearby. That helps the balance sheet long-term. They're essentially banking on the idea that the buyers they are successfully attracting, like those active adults, value those custom touches more than just a slightly deeper rate cut.
Okay, strategy aside for a moment, here's something that looks like a huge win. Cost control. Their actual build costs. Flat, year over year, and flat compared to Q2. Held steady at $79 per square foot. So the margin pressure isn't coming from materials or labor anymore. It's purely external. It's a demand issue. They've really nailed down cost stability, it seems.
Yeah, and that stability is critical because they're already looking ahead at potential cost increases. They mentioned potential tariffs possibly adding about $1,500 per home starting in 2026. So you need that discipline now. And looking ahead to Q4, they actually guided margins down slightly again to between 25.5% and 26.0%. They specifically tied that to wanting to clear out some of their excess finished spec inventory before year end.
Right, that makes sense. Which brings us neatly to demand itself. We've seen the financial fallout, but what was happening with actual buyers on the ground? Why was demand still sluggish?
Well, the overall numbers are, like you said, sluggish. Net new orders, down 6% from last year. Their absorption rate, how fast they sell homes per community, was 2.2 per month. Now, that's actually decent. It's right around the pre-COVID average, but it is down from 2.4 last year. And the backlog, those future guaranteed sales, that dropped quite a bit, down 18% in number of homes, 19% in dollar value.
And this is where we hit what the company itself called the interest rate paradox. You'd think lower rates automatically mean more buyers, right? But Pult said the positive response from consumers was, quote, muted. Why weren't people jumping when rates fell?
Well, it suggests that for Pult's main target buyers, the move-up, the first-time buyer's job security is actually a bigger driver right now than the monthly payment itself. I mean, rates were falling because the market feared economic weakness, potential job losses. So consumer confidence is still the major hurdle. People are looking, traffic was up, apparently, but converting them into actual buyers. That fluctuates wildly with economic fear. They're putting job stability first.
Okay, but amidst that gloom, there's this really critical counter story. The one thing that seems to be propping up their orders this quarter, Pulse serves those three main groups. First-time move-up and active adult across, 47 markets, and one group is just crushing it.
Absolutely.
Yeah.
The active adult segment, mostly their Del Webb brand, that's the anchor right now. Net new orders there were up a solid 7% year over year. And get this, that segment now makes up 24%, almost a quarter, of all their net new orders. These buyers are often less rate sensitive, maybe using cash from a previous home sale, lots of equity. They're providing a really significant buffer.
Okay, it's great that Del Webb is doing well, but if nearly a quarter of your new business depends on that specific cash-heavy, equity-rich buyer, does that make Pulte a bit vulnerable? Like, what if the retirement market takes a hit or the stock market dips? Is this diversification really stable long-term or more of a temporary shield?
That's exactly the tightrope they're walking operationally. And they seem aware of it. They're trying to hedge that reliance by broadening the brand's appeal. They're rolling out these Del Webb Explorer communities. These are aimed more at Gen X buyers who want that high amenity lifestyle but maybe aren't retirement age yet or don't want the age restriction. So they're innovating, trying to capture that next wave of buyers.
Right. And meanwhile, the other segments, the ones hit hardest by affordability, the weakness is clear. First-time buyer orders down 14%, move-up business down 3%. It really confirms that the diversification is working as a shield, protecting them from the worst pressures hitting builders focused only on entry level.
So let's shift gears slightly to their operations. How efficient are they being internally? Because in volatile markets, efficiency is everything.
Get this figure. They've cut their average build cycle time down to just 106 days.
Wow.
Yeah, I mean, think about that. That's like 20% faster than the industry average was only a year or so ago.
Right.
It's incredibly quick for building a new home from scratch.
And what that speed gives them is agility. Huge operational agility. They can turn inventory faster than almost anyone. That speed becomes their ultimate risk management tool, right? They can react almost in real time to shifts in demand. Look at the numbers. They started 6,557 homes in Q3, which basically matched their sales pace exactly. Their aligning starts very tightly with sales.
But even with that flexibility, they're not perfectly optimized, are they? We talked about those spec homes, the ones built without a buyer lined up yet. Specs are currently 49% of their production. That's a bit higher than their long-term goal, which they say is more like 40% to 45%. It's higher simply because they're signing fewer build-to-order contracts right now.
Right, and that leads to that slight inventory issue we touched on earlier. They have about 2,000 finished spec homes sitting ready. That averages out to roughly 2 finished move-in ready homes per community. Their ideal target, they've said, is closer to 1.2 per community. Hence that plan we mentioned, using incentives in Q4 to sell down some of that excess.
Okay, let's connect that operational side to their land strategy, because they seem really disciplined there too, despite needing to fuel future growth. Their planned land investment for 2025 is around $5 billion. That's actually down about 5% from last year.
Yeah, and the way they manage land shows a really smart approach to risk. They control a huge pipeline, something like 240,000 lots. But, and this is key, 58% of those lots are controlled via options, not owned outright. That structure is like the ultimate hedge. If a market turns south, they can just walk away from those option deals without owning the land. And they actually did that proactively in Q3 with some longer dated deals.
And looking ahead, cost-wise on future developments, they're seeing maybe some relief coming on land inflation. They mentioned getting more favorable terms on input costs for the big site prep work, moving earth, putting in utilities, what they call horizontal development.
Exactly. And if those initial site prep costs come down, that should eventually ease future land inflation pressure. Though the source material suggested we probably won't see the full benefit until, say, the back half of 2026, maybe fully into 2027. But it shows they're planning ahead, playing the long game.
Okay, so since Pult operates in so many markets, 47 of them, their results give us maybe the best single snapshot of geographic trends across the U.S. Where are things actually holding up?
Well, relative strength seems heavily focused on Florida. Orders there were actually up 2% year over year. Pretty impressive. They also called out decent performance in parts of the Midwest, the Northeast, and the Southeast, specifically mentioned in places like Cleveland, Charlotte, the coastal Carolinas, Tennessee, and also the D.C. Northern Virginia area. These seem to be markets where maybe local economic strength or population growth is just outweighing those interest rate headwinds.
And conversely, where is demand softest?
Texas was mentioned. Despite its overall growth reputation, they cited softness there due to really rapid price increases hitting affordability, plus some existing inventory buildup. And the Western markets, particularly California and Seattle, that seems linked to just high overall costs there and maybe some volatility tied to the tech sector jobs. Those are the areas where they're using the most incentives.
Got it. Okay, lastly, we should touch on the broader housing shortage issue. Management talked about this directly, connecting it to the current market dynamics. And just to be clear, we're reporting their perspective impartially here as part of the policy discussion.
Right. The company essentially agrees with the common narrative that the U.S. faces a structural housing deficit. They put the number at maybe 3 to 4 million homes short. And they point to that shortage as the fundamental root cause of the affordability crisis we're seeing now.
And they noted that fixing a problem that big isn't simple. It needs a coordinated effort. Federal, state, local leaders all need to be involved. There's no single magic policy bullet.
Yeah, and they actually offered a kind of simple mantra for policymakers to think about, a target, if you will. They suggested, for every 2 jobs created in an area, we need 1 new home built, a 2-for-1 ratio. That's what they feel should guide housing policy development.
That 2-for-1 ratio is simple, easy to grasp, but did the source material mention how to tackle the really thorny local issues like zoning, density restrictions, the whole not in my backyard thing? Because those often seem like bigger roadblocks than federal policy.
That's a fair point. It highlights the gap, doesn't it, between seeing the need nationally and actually getting shovels in the ground locally. But framing it that way, connecting housing directly to enabling job growth, is a powerful way to put it. It makes housing essential economic infrastructure, not just shelter.
Definitely. Okay, so to wrap up our deep dive on PulteGroup's Q3, the resilience they showed, it wasn't just luck. It really highlights the value of having that diversified business, different regions, different buyer types, especially the strength in active adult, which clearly buffered the hit they took with first-time buyers struggling with affordability.
Exactly. And that operational speed, that 106-day build cycle that positions them incredibly well to react. If, and it's still an if, but if consumer confidence firms up and rates maybe settle down a bit in 2026, they can ramp up production super quickly. Without those long delays we saw during the supply chain mess, they're really a company managing costs tightly while staying poised to chase volume aggressively if the market turns.
Which leads us to our final provocative thought for you, the listener, to consider. We heard they can build a home now in just 106 days, and they want to get their finished spec inventory down from about 2 per community back to their ideal of 1.2. But maybe they shouldn't rush that.
Given how much we still hear about the overall housing shortage, and knowing that buyers in this uncertain market crave speed and certainty, does having a slightly higher than ideal inventory of finished, ready-to-move-in homes actually stop being a liability for Pulte? Could it become a key strategic advantage for 2026? Having a home ready to close now might be a very powerful sales tool when buyer confidence is fragile.
Something to think about as we look ahead. Thanks for joining us for the deep dive.
We'll catch you next time.